Hello, it is Buffett Analyst here. Uh, I'm going to UATX currently and helping on the endowment fund, and I think I'm going to start posting more videos of me going through different stocks and in the hopes of educating future endowment fund members. I think that it's a lot easier to show instead of tell what my strategy is, and I'm still in the learning process. But I think there is some basics that I know and that could be useful for you guys. So in this video, I'll just go over, some introductory things, how I first find ideas. That's the first step of finding a stock. Ideas, skimming financials, asking, very basic questions about the business. And then in future videos, I'll probably focus more on the uh, deep reading of the documentation, 10Ks, 10Qs, etc. And I also just hope that these videos will be good practice for me. So let's dive into it. All right, so I'm going to pull up the document really quick. And this document has a lot of the different questions that I ask when I first look at a business. And I'll just go through a few of them. So, so this is what I first look at. What does the business do? What is its competitive moat? So what does it offer that is distinguishable from its competitors and creates customer loyalty that is specific to the brand? So, for instance, when people go shopping, people will ask specifically for a Nike branded shoe because of its comfort, because of its price, because of its style, etc., because of its brand association. Another example is the consumer psychology behind drinking a Coke. There's a very specific taste, there's a very specific sensation, and everything that goes into that experience is the mode itself. Because if another company came along and tried to make a new soda, people would prefer Coke. So that's kind of the definition of a moat. Apple, name any strong brand, and that's pretty much what a moat is. What are its past and future growth prospects? This is an important question, but it's actually not at the forefront. What really matters is not necessarily how much it will grow in the future, but you're trying to guard against the future, because if you buy a company that is overpriced, you are risking that any future adverse changes are going to drop the price of are going to drop your cost basis, and or sorry, not cost basis, your investment. So what you want to do is buy stocks that are not necessarily these hyped up fads that will go and uh, make money for like decades, exponentially, and um, all the Wall Street blabber. But what you want to look at is safe companies. These mundane companies are oftentimes the best investments. Buffett first invested in a stamp company. He also invested, in Berkshire. Berkshire was a textile mill, and he transformed it into an insurance company later on. And not even insurance is, all that glamorous. So growth prospects is not necessarily that it's some hyped up industry like Nvidia stock or something. Never buy Nvidia stock. Don't actually. I won't do stock advice, so don't take my word for it. What capital is required to offer the product or service? So that's a matter of efficiency. How much capital is needed to run the business. Software has less capital than brick and mortar. Um, by industry, it varies. Airlines have a huge amount of capital. Let's see, hotels have a lot of capital. They have to constantly maintain what they have. But on the other hand, um, related in proportion to how much free cash flow they get, Apple is a great example of not needing a lot of cash capital to fund the business, because if you look, I've checked recently, their capital expenditures are like less than 10% of their operating cash flow. So never however they spend the capital expenditure, because it is so low, their free cash flow is just off through the roof. So that's the definition of a great business. That's why Buffett has invested in Apple, and among other reasons. What is their pricing power? So, if they raise prices, would people leave? Would people go to their competitors? Say Apple raised the price of their phone $100. Would people stop buying Apple phones? Definitely not. That is a level of pricing power that companies with really dominant markets, and it doesn't have to be a share of a huge market like Apple, but it can even be a share of a niche market. But as long as you have that, you have pricing power because competitors will not get your customers when you raise your prices. But you have to be careful because if you find an industry that is extremely high margin, take for example Nvidia right now, then over time, if it's a low barrier entry, you will get competitors and they will be able to take away your pricing power. So yeah, airlines are an example of very low pricing power. If an airline increases its fares significantly, people will simply go to another airline. Like, there's not a lot of loyalty except for the miles that you have, but um, they're kind of walking a fine line, and that's why airlines have such terrible margins as an industry. It's a commoditized product. That's what I would call it. Where does the business make money? That's a foreign market question. If they're in unstable countries, you want to be careful of that. America and the West is usually a good bet. Um, China has China is arguable. I'm sort of like on the fence about it. Although companies in China can just get completely wiped out by the government at their will, um, if the trend continues that capitalism um, grows stronger and the population begins to actually consume instead of save at a 30% savings rate, then China will be a good place to invest, in my opinion. Um, who runs it? CEO? What's their management style? Are they a founder? How much experience do they have? Who has ownership of it? That's another question. Board of directors or family members or, the founder of the company who, from way back when. The question is who really has the decision at the end of the day. The CEO is the PR guy, but if he doesn't have majority ownership, he has technically no power. Um, no ultimate power, I should say. So who has ownership is a question of what will really be going on at the company. And you want to see that people who have ownership are the people running it day to day, because those people know what's best for the company most of all. Who is their direct and indirect competition? Direct is just competitors who directly take away your customers. So let's compare Nike versus Adidas. Suppose that someone who would buy a Nike shoe is then not buying an Adidas shoe and vice versa. Indirect competition is like, let's say, retail. People go to many grocery stores. So, for instance, Trader Joe's and Costco. These are not necessarily direct competition. They have some overlap, of course, but not necessarily direct. Airlines are probably another example of indirect because people jump around. At least I do. When was it established? So, was it IPO date like 5 years ago? If it was, that's a very risky business because you don't have a lot of financials to go off of. 10 years, you start to really see, are they just lucky? Or, are they just in a horrible state of luck? So, in other words, after a certain amount of time, the skill becomes more clear and you start to be able to say, the luck is probably not, you don't need to put that into the equation anymore. And of course, you want as much information as possible. So a brand new company from a year ago is not going to be a good investment. You need at least 5 years. Why is it undervalued by the market? So this can be so many different reasons. I mean, the idea of value investing is that the market misprices stocks because of their irrational behavior. I mean, people seem to think, wisdom of the crowd is just the end all be all. And stocks, but that's not true. I mean, people in places outside of the stock market and huge crowds will do extremely irrational things. So, think about all the Hamas protests. So, pro Hamas protests. So, in other words, that kind of went off track, but when you're finding a mispriced company, it's often because of an irrational behavior, a Mr. Market misquotation. Is it in your circle of competence? That is a very key question. You won't find that an intelligent investor. Benjamin Graham doesn't really talk about this much. It's really Buffett's idea, and it's just a matter of understanding the business. If you can't understand the business, you should not be investing in it. I have looked at reinsurance companies and said no, banks and said no because their financial statements are just too ambiguous. Whether there's too many, weird terminology or unexplained balance sheet or line items, you don't want to have a bunch of missing holes. And the more holes you have, the worse. So if you start to question yourself, do I really know this business? That's a sign that you probably don't know the business. So keep that in mind. And then finally, is it a sexy or mundane business? The reason why this matters is because the mundane businesses are often undervalued. These are businesses that are also very stable. The sexy businesses are like the tech companies like Nvidia, Tesla, electric car companies. What else? In the bubble of the .com bubble was like every .com company. Those companies have proven in history not to have the best lifespan. So the mundane businesses, like the ones that have products that people will probably need for centuries, like truly, like I don't know, tile, lumber, aluminum manufacturing, railroads. Like these are things that will be around. They're not sexy by any means. They're very mundane. But if you're talking about value investing, you're talking about compounding, and you want a stock that's like 100-year hold, you don't want to sell it as long as you can, as long as you can live and survive. Then you're just going down a path of following the market if you try to find a sexy business, and as a result you're not going to be able to find a lot of undervalued sexy businesses, kind of by definition of a sexy business. All right, so I'm going to start talking about just some analytical and analysis based strategies. So one place I look at, which is very good, is the Wall Street Journal 52-week highs and lows. So 52-week highs I don't really look at, mainly because I never short. I don't speculate in the markets. And I say, that's sort of a given because you want to buy low, sell high. You want to sell when others are greedy and buy when they're fearful. So these companies are examples of greedy companies, usually, if they're 52-week highs. 52-week lows, on the other hand, are usually when they're fearful. American Eagle Outfitters, I'll look at their stock right now. So I look at it 1 year, they've gone down half, which is significant. Would I buy this company? Already, industry-wise, I don't really go into fashion because sort of what I was talking about earlier, these short-term fads can be very volatile. That's probably what explains like the volatility of the stock price. I don't care about volatility of stock price per se, but I do care about long-term appreciation. So, fashion is a very unstable industry. There's oftentimes so many companies I've never heard of. To be honest, I skip over them. I probably shouldn't. But the ones that I never skip over are the big brands. If you find a big brand in here that you're just like, what? That's a 52-week low? Then it's worth looking into. American Eagle Outfitters is a pretty big brand. I've never heard of any of these. I mean, I'm familiar with the markets. Cable One is big, but I know by the name, it's in cable TV, and maybe justifiably a low. Canada Goose Holdings, that is an alcohol brand, if I'm not mistaken. No, wait, can't be a fashion brand. Oh no, I was wrong. Okay, so this is a fashion brand once again. It's Canadian, which is not the best. Canada has had a very unstable political environment. Let's look at Carter's. I think that's a kids clothing and products company. Children's apparel, another fashion brand. PE ratio of 7.77 is quite good. Let me take a look at some of their financials. So this is when I let's go through some of these questions for Carter. So what does the business do? Children's apparel. What is its competitive moat? That's a good question. How do you go about finding that out? Well, you can look at their Wikipedia. Let's see if they have anything. This is all about acquisitions, headquarters, Oshkosh Begosh. Nothing here. Let's see. Usually in the 10K that they will always have some competitive overview. You know, why is this business competitive? Open document, business, strategy, elevate the style and value. Yeah, I'm just not a fan of fashion. It's just so unstable. I mean, you're literally just betting that, you know, people are gonna just like the style of something. That's not very. It just doesn't last. It's too fatty. Fad. FAD. U.S. wholesale marketing strategy. I don't really care. Yeah, this is not good. I mean, they're just saying, you know, I'm going to improve my marketing. I'm going to make my style much better. I'm going to have a bunch of rewards. They can, you know, they have a bunch of licensed products, which is higher return on capital, but then they have to buy all the equipment to manufacture their clothing. I'm going to look here. I'm going to guess their capital expenditures are a ballpark of like 50% of their operating cash flow. Don't take my word on that just yet. Financials, cash flow. Okay, so it's actually less. It's about 1/6. Sorry, 1/5. So 20%. What are their returns on equity over time? Return on equity over time. This is actually similar to Nike's return on equity. This is pretty impressive, actually. It's impressive because there is growth and because of the absolute number. This is between 14 and 40%. Just for perspective, Nike, which has a very high return on equity for also an apparel company, 23 to 40%, peaking at 50. Carter's is definitely lower, but it is impressive. What's their debt? Okay, it's less than 1, which means that they have less long-term debt than they do equity. Let's look at their margins. I'm going to take a look at their competitors really quick. You know what? I'm asking ChatGPT. What are Carter's competitors in children's apparel market? The Gap, Navy, Target, public companies. Gap, Walmart, H&M. Yeah, I'm kind of wasting my time with this stock because I know that I'm probably not going to invest in a fashion brand. Let's see. Okay, so net of 7%. This is pretty expected. If I look over here, oh, whoops. If I look over here, I can sort by industry. If I go to industry and I select apparel, Carter's should show up somewhere. Children's Place. But let me take a look at all these guys' margins as an industry. Yeah, I mean, profit margins are very, very meager. This is below 10%. As you know, just to give you guys perspective, let's find software. Or no, let's find computer hardware. Profit margin 40%, 17%. These are these are losers at the bottom. Here, let me do something different. Electronics, computer distribution. Oh yeah, information technology. Let's see, information technology services. Okay, no. I'm kind of looking for Apple right now. Okay, software infrastructure. Okay, yeah. Now let's look at their margins. Okay, this is all above 20%, 20 to 50% profit margins, and you compare that against apparel, it's kind of meager. So there's that. You want high margins across industry, lower margins across business. If I compare, let's say, Children's Place, which is their competitor, PLCE, profit margin -12, ROE, they're struggling. Yeah, it's hard to compare them against such a horrible business. I'm going to skip this one and go to the next because this is not good. 10% operating margin over time. If I take a look at Nike, once again, then we can see 13% operating margin, net 10%. This is sort of the story of apparel companies. Buffett did not invest in a lot of apparel companies. He did invest in Nike for a time, but he sort of backed in and out of it. So Canada Goose, no. Carter's, no. Let's keep going. Never heard of these. I've never heard of these. When it ends in ADR, that usually means it's some foreign company. You can also check if they're reputable, if they have like volume, like 0K. Well, that probably means that they're not a very reputable company if they have no trading volume. People always need furniture, but there is so much competition. It's kind of hard to. You don't have a lot of pricing power as a furniture manufacturer. People don't really care that much. Ardent Health Partners. I'm kind of interested to what they do. Ardent Health Partners. Let's see. ARDT. What do they do? All right, SEC it is. Ardent. This is the greatest website to find super fast information on your company. You can use ChatGPT, but this is straight from the source. Healthcare services. Joint venture model. Yeah, I happen to be a little bit familiar with the healthcare market. It is crazy the amount of subsidization that is in the American healthcare system really hurts the margins of all urgent care centers, primary care. It's basically a centrally planned way to distribute funds because doctors are not paid off the amount of expenses. Um, yeah, they have a joint venture model. That's interesting. I did not know that medical centers did this, which should be kind of obvious. They operate 18 hospitals. Ugh. I'm gonna guess this has like very, very low capital efficiency. If I go here, Macro Trends is a great website. Revenue, financials, cash flow statement. Yeah, I mean, it's, oof, wow. And they've only been around for 4 years. Is that true? Let's look at SEC. Filed from, let's go all the way back. Search. Nope. Okay. Work. There we go. How many showed up? Yikes. 10K. Not investing for the same reasons that I stated, that they need to have much more financials to warrant an investment. Okay. Canada Goose, Carter's, Future Fuel, Haverty, Interpublic. Interpublic is a big business. Hillenbrand is a big business. Hillenbrand, let me check on that. That does oil, right? Hillenbrand. Food equipment, industrial equipment. This is interesting. Highly engineered process, material handling, equipment systems, and aftermarket parts. Highly engineered equipment, strong product. This is interesting. They have a very, shareholder-friendly, manageable return capital, operating efficiency. These are sort of key terms that you look for. This is not a key term that I look for. EBITDA is not a good metric. It doesn't take enough into account. I mean, it literally gets rid of all depreciation, amortization, income tax. It's revenue. That's basically what it is. DEI of that. Advanced process. Okay. What do they do? So industries including plastics, etc. It's highly engineered capital equipment, aftermarket. Twin screw compounding and extrusion machines. Okay, there are a lot of applications. They build machines. They build equipment. Blenders for pellets and planters. Where are their part of advanced process solutions, sales, mixing technology, competition, brand name, customers, design, quality, strong competition, worldwide network, raw component materials, strategy, leverage global footprint, aftermarket. I mean, they do have this this need. Like they are mundane business, for sure, which is good. This is the good type of mundane. I wonder. I mean, this is what Phil Fisher talks about when he invested in a lot of industrial stocks. How do you determine if an industrial stock is good? Usually, you want to see historical innovation, historical breakthroughs. He started with Texas Instruments, who was really able to emulate that. Hillenbrand intellectual property, Catron, important trade secrets, drive innovation. What is this? Molding technology. CEO 2021. Okay. This is a good business, I think. I'm gonna look at the macro trends. That's not good. Okay, that's not good. So their ROE has gone down over time. Their equity has gone up while their net income has gone down. That is a very bad sign. That shows a sign of a bad capital allocation. Price ratio, let's look at their PE currently. They're at negative. If they were not negative, let's say it would be an average of 3. That would be about 8 PE. I would probably pay around that, but it's not a great business. That's the thing. Profit margins have been falling over time. Something's going on with this company, that's for sure. Something not good. Financials. There are a lot of ads on this website. Dude. Financials, please, thank you. Okay. 191, 2.1. They don't have any capital expenditure for the year 2024. It's kind of weird. Net income and loss. What happened recently? Seems like over time. Okay, I'm gonna put this company aside for now. This is not a no, this is not a yes. I'm definitely leaning towards no because of that really bad problem with the ROE. Because they're falling, that shows kind of a limited capital efficiency. But this could be a good, fair business. It's not. It's definitely not great. That's definitely not the 100-year stock that someone would invest in. Let's look at Interpublic. They're going through a merger with Omnicom. There's a lot of uncertainty with that. This could be a good stock to just hold for a little bit. I'm gonna go straight to macro trends because I sort of it's not their stock symbol. What is their stock symbol? IPG. Okay. Financials, cash flow. Wow, yeah. So this is kind of sort of the nature of an advertising business. You basically have no capital expenditure. I mean, you're kind of a cash machine. Like everything is royalty. If someone wants to promote their business, someone wants to do anything related to like sales, marketing, they have to go through IPG as an intermediary. So they're sort of like a toll gate. They're able to just generate cash at a very, very low capital expenditure. They basically just need talent. They need a place to do their work, not necessarily even in person. But that's it. They don't need any manufacturing tools. They don't need to have this, giant factories. Yeah, this is sort of the definition of a good business. Buffett actually invested in a lot of advertising companies, going down to newspapers, just because of how much cash that they generate. The net 10%, operating 10%, growing over time. This actually might be a good thing that they're so low, because if they started increasing their prices, I mean, while advertising does have a big cash machine, it is sort of not doesn't have as much pricing power. If they raise their margins significantly, they would lose customers significantly. People would just go to wherever the best advertising is, not necessarily because it's some renowned brand like Coca-Cola or something. I do know of, is Omnicom still public, even though that they're going through the merger? Oh, they are. So I can compare them pretty similar. They have very, very similar size and method of business. So IPG OMC is the Omnicom. These guys are maybe merging, by the way. Profit margin. I know that's pre-tax, but that'll be proportionate to whatever the profit margin is. This is net. So yeah, very comparable. It's around 10%. Let's take a look at revenue. Omnicom, yeah, revenue definitely has grown over time. This is sort of, it's giving me signals like, why the hell is this company a 52-week low? This is definitely a great business. It's advertising. It's a cash flow machine. Is there some big scary debt that I'm not looking at? I mean, let's check. This is sort of what you have to ask yourself. Why is the market undervaluing this? What are they seeing that I'm not seeing? If you can't come to any rational conclusion, then the market is not being rational. I could probably write that in the investment strategy. If you cannot come to a rational conclusion, the market is not being rational. We could be having a buy on our hands. Maybe not a buy for 100 years, but for the time being. This is a Dondo stock. Dondo stock is low risk, high uncertainty. PE ratio, price increasing over time. PE ratio about 14. Sort of stable. This is very average. I mean, 15 is not very high. This probably prices in, yeah. I mean, the revenue has grown, but it's not like crazy. But that's fine. Doesn't have to be. Uh, Other ratios. Let's look at ROE. Last time we did not get so lucky with Hillenbrand. Let's look at now. ROE 30%. I mean, like this is sort of typical of a really high efficiency business. They have dropped recently. Who cares? I mean, this is a trend over time that you see, you know, growing from in 2010. In 2010, this is probably from a trough in the business cycle, but either way, they've grown over time. At least they've maintained above, on average, 20% ROE. That's pretty good. They've grown their equity slowly. Not sure equity is the best metric for advertising. Usually you constrain that to insurance. They got a bunch of debt in 2019. They paid it off since then. You know, they're able to pretty much afford a lot because they have so much free cash flow, as we saw earlier, as calculated by operating minus capital expenditure. If you look at their current ratio of 1.09, that means current assets minus current liabilities is greater than 1. Current assets is larger than current liabilities. They're meaning solvent in the short term, which is, this metric doesn't really matter because they can always raise new money. They can always sell assets. I mean, there are a lot of ways to raise cash in the short term, even though it would bring down other values in the balance sheet. So let's look at shareholder friendliness. This is sort of the next step. Like, are they friendly to shareholders? Do they repurchase shares? This is a good business. I mean, that's stock dividends paid. Then they repurchased in the past 3 years about $1 billion, and then stock dividends paid in the past 3 years about $1.5 billion. So, and you take a look at their free cash flow, and you're looking at an average, let's see, this is hovering at around 750, an average of about 150 per year. It's about 600. Notice I don't need a calculator. 600, and then they're returning value to shareholders in about that amount per year, about 600 million. So, you get a big bang for buck just having the stock, because you have cash and your shares are appreciating value because there's less supply of them. That means their literal intrinsic value is increasing. I'm going to look at their stock price, actually. This is not recommended, but if you find a company through this way, 52-week low, you kind of how low is it? So 30%. What is Omnicom doing? About 23% recently. Yeah, I mean, this is a good business. I would put this on my watch list. However, I probably won't. One, I need to know more. The other thing is, like, the market doesn't necessarily hate the stock. One might think that's a good thing, but is it really undervalued? Does that really follow? I'm not sure. I also don't know a lot about the advertising industry. So, for those reasons, it's a solid company. I'm just going to put it on the list. No shame. Oh, it's already on the list. There you go. Okay. All right, let's do a few more. Interpublic, Kohl's, looked at that before. Kohl's is down like at least 80% since this 52-week high, or at least 2-year high. March 4th, 2020, 86% down. I mean, people think that this business is done. It's at $8 a share, man. I think I was looking at it probably around 20 a share, I want to say. Wow. I did some research into it. They're putting Sephora's in their stores. People mainly just think that their department stores are just gonna pretty much crumble under, e-commerce, etc. Yeah, I mean, this is not a great business. That's all. That's it. That's it. Like, great business at a fair price is way better than a fair business at a great price. That's sort of what I've learned the hard way. Marriott. Look at this. It's not the best. Oh wait, this is Marriott Vacations though. Vacations. Slightly different, I guess. This is interesting. Why is it so down? What is this? Macro trends. What is Marriott Vacations? VAC. Nope, that's not what I'm looking for. VAC macro trends. There we go. Financials. Let's look at cash flow because I usually want to know what their capital expenditure is. That's not. Capital expenditure is like nada. Or it's very small though. It's like, oh wait, but this is half. So that is significant. What is going on here? Why is there no values in here? Margins, sort of gauging what's going on. Okay, kind of low, but their gross margin is extremely high, 90% gross margin. So why are their net margins so low? It's kind of weird. EPS. Their stock price is going down, yet their EPS is not really done much. This is a point where you kind of want to ask, what does the business do? I will be asking and looking that up right after this. ROE. Return on equity is just going to be total assets minus total liabilities. Earnings. Load, please. Okay, I'm going to pause there. I think I will leave it on a cliffhanger. So what is Marriott Vacations? This is the assignment for today. Yeah, find out what that is. Get back to me. And then, in the next video, I'll probably talk a little bit more about this company, look at more 52-week lows, look at some of my watch list items. Why are they in there in the first place? And one of these days, go through FinViz. It's a really good screener, just showing how to use it. Okay. Good night, everyone. Thank you for watching.